Investing has evolved so much since you started your working career, and now it's time to get up with the times and learn everything you need to about exchange-traded funds, or ETFs, now that you're getting closer to retirement.
Yeah, it started off with buying individual securities like individual stocks and bonds, and now we moved to actively managed mutual funds, and now we're at ETFs. And the reason we like ETFs, or exchange-traded funds, is because they are more tax efficient, they trade for free, and they're low cost.
And in today's episode, we're going to give you everything you need to know about how to choose the right ETFs for your portfolio. We're going to talk about the good, the bad, and the ugly. And guess what? They're not all created equal. We're also going to give you some tidbits for how you should approach ETFs in 2026 based on what's happening this year. I'm Brad Lineberger, certified financial planner.
And I'm Matt Callahan, certified financial planner. And this is Navigating Retirement. Let's jump in.
Matt, you really hit it. There's been such an evolution in the investment world over the decades. I remember when my Uncle Chuck, God rest his soul, was selling deep value stocks, and people were paying heavy commissions to buy stocks from a broker. And then that gave way to mutual funds where you had a manager and people pooled their money together. But the future is here, and it's really exchange traded funds, or ETFs. That seems to be the way to go.
Yeah, I love it. And I mean, going back to the individual stocks and things, I mean, you used to have to be ultra wealthy to build a robust portfolio because you had to buy all the individual, funds within there. Right. And then the mutual funds, like you mentioned, is just the pooled investment, which everyone gets to buy into the same security or basket of securities, and then everyone gets the same price at the end of the day. So with mutual funds, just as a background for everybody, is if I purchased a S&P 500 mutual fund at 9 o'clock and Brad purchased at 10 o'clock, we would both get the same price at the end of the day.
Right.
And so with exchange traded funds, lower cost. I mean, there's not a fund manager like you mentioned with the mutual fund.
Those mutual funds were so expensive. Mm-hmm. Internal expenses north of 1%. Mm-hmm. It's all hidden fees. I mean, you can see it's public information, but most people aren't paying attention.
Yeah, you need to look at the internal expense ratio.
Right.
So hidden fees, like you said.
And those mutual funds were so tax inefficient. We still have clients that have had mutual funds for years that they can't get out of for tax purposes, and they get that dreaded 1099 at the end of the year. They didn't sell anything, and yet their manager did. So the client is on the hook for the tax bill.
Well, this is a great point of why they're so inefficient in terms of that. So to unpack that a little more is that, let's say the S&P 500 mutual fund that you own, and I'm picking the S&P because most people are familiar with it. But if that fund manager is buying and selling, well, as stocks are going up and down, you as the owner of that fund may not have sold anything, and you're still getting passed down those capital gains or income to yourself. And so you're paying taxes whether you didn't sell anything or not.
Right.
So what's actually happening is that the fund managers are buying and selling securities that is going to cash. So it's an actual transaction. Right. As opposed to exchange traded funds, one of the reasons that they're tax efficient is because even though that you're part of an ETF of the S&P 500, cash is not being exchanged. They're actually exchanging shares. So that's why it's not being taxable to you. So even though you sold something personally, the fund is not necessarily selling shares to get you that cash.
So what I like about ETFs are that they track broadly diversified indexes like the S&P 500 or the total U.S. stock market or the international markets. So you get that diversification. The internal expenses on the ETF are really, really low. So you start to save money. Mm-hmm. Not all of them, but on the good ones. The tax efficiency that you pick up, I think, is a huge saving. So I think there's a lot to like about ETFs.
But going back on the cost, I mean, we're hitting this hard, and yeah, it's better to, have lower expenses because that means more dollars in your pocket for retirement. But that doesn't mean that higher cost investments don't make sense. I mean, you just need to know why you're buying. Does it make sense to accomplish your goals and values?
True. But when we look at ETFs versus the actively managed mutual funds, so many of those mutual funds were underperforming their passive benchmark because of those costs.
Well, we call them closet indexers. So think of the S&P 500. It's a passive index, and a lot of these active managers are just following the index. So you're paying.
So they don't get fired.
Yeah. So they're following the index. You're paying the higher cost. So what if let's say it's 0.75% internal cost on the mutual fund. You can get the same S&P exposure with 0.03%. So 3 basis points. I mean, that's significant savings.
Right. It's almost free.
Yeah, almost free.
Yeah. Okay. So with that basic understanding of what an ETF is, and by the way, at custodians like Schwab and Fidelity, the ETFs trade for free. There's no cost to trade, where most of the mutual funds, there is a cost. So that's another reason to like ETFs. So now that we have that basic understanding of what an ETF is, let's talk about, can I get exposure to different areas of markets? How does that work with these ETFs?
Yeah, very, very similar to your mutual funds experiences, that you can buy different sections of the market to build your asset allocation. So I know we've been saying the S&P today, but yeah, you'll want S&P, you'll want small US companies, you'll want international companies, real estate companies, and typically all the investment world is offering exchange traded funds in lieu of their mutual funds.
But they're not all created equal.
This is right.
So what are the things that we have to watch out for? What are the landmines that people could step on if they're not paying attention?
I mean, those internal expense ratios. I mean, yeah, we're saying ETFs are cheaper, but some of them can be super expensive if you don't know what you're getting into.
That's right. So there's that. There's also what's the objective? What's the goal or the purpose? And so back in the day, the ETFs were really straightforward. Let's build something to track the performance of, say, the S&P 500 or the Russell 2000. It was just like an index or an ETF to track that index. Now there's totally different objectives. In fact, we're seeing some ETFs that are active ETFs. This is blowing my mind.
Yeah, and some of the things I don't even understand what they're investing in.
Right. So it's like what Warren Buffett has always told us is you make sure you know what you're investing in. And if you don't understand what they're investing in, you shouldn't own it. Right.
Yeah, absolutely.
Okay.
And the objective, going to that though, I mean, if you read the fine print, this is a fun fact that I saw, it says not required to meet objectives. So just know what you're purchasing and what you're trying to accomplish.
And so people are going to find that in the prospectus. And even though, we always joke, if you can't sleep well at night, go ahead and read your prospectus because it'll help you fall asleep.
But there is something called the fact sheet. So it's basically the summary of the perspective. It's 1 to 3 pages. It'll give you your top 10 investments within that ETF, the countries that you're investing in, the asset allocation, what they're trying to, the objectives. So a number of useful information on the fact sheet.
Okay. So now that we've educated the audience on what to watch out for, let's talk about the first philosophical decision that somebody needs to make when using ETFs in a portfolio. And that is, do they go broad-based, capture the total U.S. stock market or even the total world market? Or do they go more sector or asset class specific? For example, small cap value or large cap growth, or even sectors being like technology or commodities, that sort of thing.
I mean, I stay away from commodities in general. Just over the last 15 years, they've been underperforming, but that's for a different day. But I go more broad-based. I mean, what I think of is that it's really hard to be specific and get it right a number of times in a row. Yeah. So if we go back to a few years ago, 2023, the FANG stocks, we all remember, right? Facebook, Amazon, Apple, Netflix and Google. So all these companies, the 7 companies that drove the performance of the S&P. And some of you did really good in those stocks, but the S&P that year, the rest of them were down, negative for the year, but the overall basket of securities was up. So I'd rather not have to play the guessing game of which one of those stocks is going to perform in any given year, and just get the basket of the S&P as one sleeve of your portfolio.
Right.
You mentioned the small U.S. companies. I mean, we would love to get into a company like Apple back in the 70s or 80s, but no one knew what those companies were. So I'd rather buy a Russell 2000 index fund, just capturing all of those small U.S. companies. So yeah, in general, I'd rather have a basket of the broadly diversified.
And when I look at the way that advisors are using ETFs to construct portfolios, I think even that has evolved significantly over the years. What I mean by that is, I think back in the day, and we've had lots of conversations around this, but back in the day, advisors were constructing a portfolio. Okay, I'm going to have some money to small value, some to small growth, some to mid value, some to mid growth, large value, large growth. We'll do that on the.
Admittedly, I was one of those people.
I think we all were when ETFs were coming out. But again, as everything continues to evolve and improve, I now believe there's a better way to do it with this evolution. So the challenge, if you are constructing a portfolio using really specific asset classes, I guess the good thing is you can target that asset class. But the problem is, what happens when that small growth company now becomes a medium-sized company or a large company? Now all of a sudden the ETF has to make a change, or you have to change your ETF. They are making these ETFs that instead of capturing just little components, you can get the whole thing. And what's coming to mind is the US stock market, say the Vanguard Total Stock Market or Dimensional Funds US Core. There's all sorts of different manufacturers of these ETFs, but the broad-based allows you to own a company, whether it's small, medium, or large. You don't have to make any change.
Right. Yeah, I like it. It's similar to the concept, kind of, where people are like, I have my IRA over here and I have my IRA over here. I'm diversified. No, you're not necessarily diversified because all your eggs aren't in one basket.
I've got 5 old 401ks. I've diversified. I see that.
Yeah. So just like you're saying, instead of having, a small cap fund, a mid cap fund, and a large cap fund for US, Vanguard Total Stock Market covers all of those areas. And it may not look sophisticated on the outside, but underneath the hood, there is a lot actually going on.
So in my opinion, I think that's the more effective way to go. I think it's more efficient. It's certainly tax efficient, keeps those costs lower. There's less activity that's required. But to your point, it looks less cool. It looks less sophisticated. And I still think there's advisors out there that want to look like they're, air quotes, doing something, but the reality, sometimes doing nothing is the most effective thing. That's why you want to work with the fiduciary that puts your best interest first.
Yeah. And I mean, getting those consistent, predictable returns over the long term. I mean, more and more people that we're talking to seem to just want their plan to come to life and that they don't run out of money in retirement. So you don't need to hit home runs. Singles and doubles win games.
Totally.
Right?
And I think that's what the broad basket ETF gives you. Now, there's some people out there that like to use ETFs to get really targeted. I mean, beyond asset classes, the tech sector or the automotive sector or whatever sector it may be. I don't like that because I think that you're starting to you're making bets on the market. And I think investing should not be treated like gambling.
I know. And I mean, so FANG has evolved. I got to let you know, piggybacking on this, is that now we're looking at the mango stocks. And going back to your point earlier, so I'll name off of the stocks that are involved here, but one of them at least, I don't even know what they do. So we got Microsoft, Anthropic. Do you know
Anthropic?
I don't know what they do.
I don't know Anthropic.
So, but we have NVIDIA that's been up there. We've got Alphabet or Google, and then we've got OpenAI. And I know we all love our ChatGPT, but again, like hyper focused in these things that grew really quickly, and what goes up has to come down at some point.
Right. So to your point, rather than owning either a targeted ETF or the stocks themselves, go broader, go with the S&P 500 or go with a total US market. You're still going to get exposure, whether it's Mango or FANG stocks. It's going to benefit you in the long run. It's going to increase your probability of success, and it's going to decrease the chance of swinging and missing.
Right. Well, I mean, OpenAI is not even a public company yet, but just for people out there, you probably know, but Microsoft is the biggest holder in OpenAI. So you do have exposure there, and you don't need to buy Microsoft individually. You can go back and get the broad S&P 500, and there you go.
Okay. So let's talk about what can go radically wrong with ETFs. And let's talk about some of those things that people really need to watch out for. Some of those really bad ETFs.
Oh yeah. So I mean, we did some research on some of these bad ones.
Oh my gosh.
The hidden fees. There's a BizD. It's a Van Eck, and or should we not say any names of people? Well, this is all true. 920 basis points is what the internal expense ratio is.
That is so expensive.
That's 9.2% on the fund.
So your investment has to be up 10% in order for you to be up 0.8.
Yes. So other ones to watch out for, I mean, there's the Putnam BDC Income ETF. So that's 13.94%. And then we've got the Virtus Private Credit Strategy, which is 8.3. These are all internal expenses. That's not their rates of return.
Right. I don't understand how this is even allowed to. That was the beauty of ETFs, is they were super low cost. They would just absolutely blow away the mutual funds. And now with this evolution, it's just another thing that consumers have to be aware of is they're not all created equal.
And then comparing those internal expense ratios, I mean, just look at VOO, that's Vanguard Total Stock, Vanguard's S&P 500, 0.03. I mean, That again, I'd rather capture the broad market and get consistent returns, really good returns.
Now, what about this question, especially when it comes to VOO or any other S&P ETF? There was a stretch of time there where people were like, why don't I just make that the main holding in my portfolio? It is diversified. I'm checking that box like you guys tell me. What if I just put everything in the S&P 500 ETF?
So a couple of things there. I would say if you were a person that was investing in just individual securities at first and you transitioned to an S&P 500 fund, that's way better than what you were doing before.
Step in the right direction.
We're moving them in the right direction. But I mean, no, we don't want just international investments because not international, sorry, U.S. investments. Because there's been a few times in history that the S&P 500 has gone ice cold for a decade, losing 1% a year for a whole decade.
2009, the lost decade. The 60s and 70s, the stagflation. U.S. market lost out to money market funds.
Yeah, I love the way that you say it sometimes too. Of if you were invested only in the S&P 500 during these times and you took out just 5% of the portfolio year after year, I mean, you went back to work at the end of this as the Walmart greeter to just make ends meet.
You're in the middle of retirement and you're worried about running out of money.
So I mean, we love the U.S. We don't want to say anything against the U.S. That's we're tilted heavily towards the U.S., but you need to have that international exposure too.
Yeah, and I think this is all part of that evolution of investing that we're talking about. It's no longer is it individual stocks, no longer is it mutual funds, no longer is it one or two ETFs. You either need to have several broadly diversified or something like 8 to 10 ETFs might be what it takes to really now granted, people can do this with 2 or 3. You got to know what you're doing and you have to understand the ETFs that you own. But something like 3 to 10 ETFs, I think, is what it's going to take to get the job done.
Yeah, and then speaking of these ETFs, you don't want different ETFs and different accounts. You want all of your portfolios kind of working together. I compare it, the analogy I use is if you need knee surgery or something and you go to one doctor and have them do half the work there, and then you go to your other doctor midway through the surgery and say, hey, can you fix this up? They don't even know where to begin. You're creating overlap and redundancies in your portfolio.
Right, absolutely. And then another kind of fun fact, most, if not all 401k plans do not allow you to have ETFs. Now that may be changing in the future, but right now 401ks are the worst culprit. That's where you see a lot of the it's all mutual funds, many of which are very expensive. So if you're out there and you have an old 401k from an old employer or multiple, as we see in many cases, that's where you want to consolidate them into one IRA at one of the major custodians, Schwab or Fidelity.
But what about the people they say they come to you, have my old 401k, I don't pay fees in that 401k.
Oh, but you do. You do. You just don't know it.
Yeah.
They're hidden. There could be a fee to the TPA. There's a lot of bloat inside those mutual funds. Look at the prospectus and the fact sheet because it's hidden, but it's there and they're quite expensive, at least from the ones I've seen.
Yeah, definitely.
Yeah. Okay. So let's talk about, as we start to think about, we're getting close to the end of the year, we're thinking about next year, and we start to think about what ETFs, let's talk about what's done well this year, and then let's talk about how people should be positioning for next year.
Yeah, great question. So some of them that come to mind, we have a Vanguard Total Stock Market. It's up 14% at the time that we were looking at this. So that's the broad U.S. market, so large mid-cap and small U.S. companies, actually some mega companies as well. Yep. Then we've got Vanguard Developed Markets, so the international exposure. I mean, listen to this, 29% up year to date.
Yeah, smoke in the U.S.
Yeah, right. And then so in Vanguard International Markets, we haven't seen it in so long. It's very exciting to see. Yeah. And that's actually giving more returns to some of our investors' portfolios. And they're maybe beating the S&P, which you shouldn't compare that as your benchmark, but just something to keep in mind.
Right.
Then we've got DFA International Small Cap Companies up 38%.
Right.
So not a big portion of the portfolio. There's more volatility in there, but
higher risk, higher return.
Right. So yeah, those are some of the good companies that we've seen so far year to date. Gold actually has been up year to date.
Gold has had a phenomenal year. So I'm glad you brought that up. Yeah. What's your take on gold?
So gold if you look at history compared to the S&P 500, it's actually well underperformed. And so I just don't think that it's easy to put a value on it, or because of the goods and services that it doesn't produce.
Doesn't make anything, doesn't do anything. And yet there's people out there that they love their gold.
Yeah. And so I know gold is supposed to be a hedge against the market. So inverse correlation, if markets are going down, gold should be going up. But my view on it is that it should be a small portion of your portfolio. And so most of the time, commodities, at least over the last 15 years, has underperformed.
Yeah.
And so I would rather see you deploy that 5% in your diversified portfolio to get the better returns more consistently than trying to just have a small hedge against down markets.
And the philosophy that we like is rather than owning the metal itself, own the companies that are involved in mining it, drilling for it, processing it, distributing it. Own companies that actually make and do things and have profits.
I use an iPhone, for example. I know that Apple produces goods and services. You can physically see this, and it produces it, and people will buy it. I mean, the new ones that come out every time are just selling way over expectations.
But for our audience who's still not convinced yet, there are ETFs where you can get exposure to gold. Talk to us about that.
So if you want to have exposure to gold in an ETF, just be aware of the tax consequences.
Yeah.
If it really is tied to physical gold, you're going to be paying 28% taxes as commodities tax, or commodities tax, right?
So that kind of kills the tax efficiency that we love about ETFs. Yeah. So, but if you must, there are ETFs out there. In fact, there's even ETFs on crypto. What are your thoughts on those?
Crypto, the thing most people are buying and selling this on the short term, meaning that now they're running into short-term capital gains taxes, which is your ordinary income rate. So just be aware of how taxes work and using ETFs for the lower cost, and be aware that of the internal costs of each of these too, because some of those ETFs are a lot higher than the low-cost ones.
Right, absolutely. Okay, so in general, I think ETFs are absolutely the way to go. I think you need to study what's in your portfolio. I would not be using individual stocks. I would avoid those really expensive actively managed mutual funds in your accounts. And I would start to position your portfolio using all ETFs across all your accounts, your IRAs, your Roth IRAs, your taxable brokerage accounts. I think now's the time to do it. So if you have questions about this, or if you want an analysis to determine what's the most efficient way to either transition into all ETFs or the ETFs that you have going, how to make them most optimize them basically and enhance your performance, your risk-adjusted returns, give us a call. Get in touch. We're happy to help you. This is what we do all day. We're passionate about what we do. So if you need some help, get in touch with us.
Yeah, we could put together a portfolio audit and just see if you do have overlap or redundancies in the portfolio, what your internal expense ratio is on average with the total portfolio, and just give you some general guidelines of what you could do better to potentially stretch out those dollars.
Absolutely. We hope you found this helpful. As always, we're your partners here on the journey, and we look forward to seeing you and hearing from you on the next one.
Thanks for listening. If you're watching us on YouTube, be sure to give us a like and subscribe. And if you want the audio version, you can visit us at navigatingretirement.net. You can find more information about the show, and be sure to watch some of our older episodes. We'll see you on the next one.